the one anomaly in the puzzle is that people shouldn't be feeling better because the jobs market is so terrible and unemployment is likely to keep rising. And this comes back to your portion of it, but of course it would be an anomaly and people should not feel better if mood were exogenously caused, but is endogenously regulated, and it precedes social actions, which produces events such as job creation and elimination. That people feel better is evident in our rising sociometer, the stock market. So everybody feels better, right?
Exactly. And many of the economic indicators have improved somewhat because people feel better. They're taking some more risks, they're borrowing some more money, they're hiring more people because they feel a little more optimistic. Others, as this guy pointed out, haven't really improved very much, such as house prices. I know the latest report was that they were up slightly, but the overhang is so tremendous that, as this economist said, gee, if you look at it objectively, you shouldn't be that thrilled. Well, he's right, but most people are not looking at it objectively. They're looking at it subjectively based on the mood that they're in. So they feel in their bones that we've turned the corner and everything is going to be fine, and so they say so.
Let's talk about the U.S. dollar here. And, the fact that you pointed out in a couple of interviews recently on CNBC, maybe Bloomberg, that the bulls had reached, I think, 98% or 7% at the high there, Bob, and then they fall into 3% or so here on the decline. And what is the meaning of that for you looking forward?
Percentage bulls at the high, I think, was 94 or 95%. At the low, the percentage of bulls was 3%. And I believe that's the lowest number that's ever been recorded for the U.S. dollar. There have been several others in the past. But it's classic. When the dollar was at a top and a great time to get out of it, everybody loved it. And when it's at a bottom, everybody's calling for hyperinflation, and the dollar is the worst investment in the world. You need to load up on commodities. And we're taking the precisely opposite stance. I published after the close August 5th saying the dollar was making a major bottom. So far, that's the low day. We've got our fingers crossed on the precision there. That may not bear out. But overall, I think for the next year or even two, we're going to see an up dollar, not a down dollar. And that's going to surprise so many people who are positioned for hyperinflation.
When you look at Socionomics, maybe we can relate this just for a minute to the press, but as you know, Bob, so many articles, so many things on TV, be it a Bloomberg or any other network, it's almost like the end is upon us for the dollar, right?
Oh, yeah.
And so you then end up with a very crowded trade, which we're seeing on the futures side, as you have the small specs and large specs long the dollar. The commercial's the most short they've been in over a year.
Oh, and you've got some of the most famous people in the entire world in the investment community coming out in June and July and August saying the dollar is toast, we're going into runaway inflation because of the Fed's policy, which makes sense, but unfortunately it's not going to work because everything makes sense at the wrong time.
What about the press side of things, though, where you have all of these reports on TV and in the press? Can that be related to Socionomics to a degree, this continual trend of, sort of end of the world with regards to the dollar?
Oh, yeah, the press is part of the herd. They reflect very well what the herd is thinking. Most of the press came out in February and March saying, worse since the Great Depression and all that sort of stuff. So many technicians use magazine covers and the quantity of stories about a certain topic as contrary indicators, and they tend to work very, very well.
Would you mind discussing a bit more the value of the law of patterned herding in accounting for individuals' financial behavior within transactional systems?
What this law will do is enlighten a person to stop looking at all of the wrong things. Most investors by far spend all their time looking at news events, trying to figure out what the economy is doing, trying to figure out what the president is going to do. Absolutely none of that affects the stock market. If you can stop in your tracks and realize that the stock market is moving because of natural changes in waves of optimism and pessimism, then all you have to do is focus on the structure of those waves and the psychology, as revealed by several indicators, one of which you just mentioned earlier, behind the stock market, as a good example. And once you've got that orientation, it doesn't guarantee that you're going to be a brilliant investor, but it will pretty much ensure that you won't be guaranteed to be a terrible investor, which ultimately happens with anyone who's trying to follow so-called fundamentals, because the fundamentals are not precursors of stock market movement. They are the result and the lagging result of social mood trends that have already happened.
Along the lines of hurting, Bob, the daily sentiment index of small futures traders hit a significant high, and this is with regards to the stock market, as you know, of 88.5% bulls, right at the highs in October of 2007. As you know, we had the big collapse, Bob. We've had this big rally, and now you're getting cautious again. And this massive rally we've experienced, we just matched the number of bulls at 88.5% this week. Did that surprise you? That sub 10,000 on the Dow that we have matched the 2007 highs with regards to that reading?
Not at all. In fact, way back in February, I think it was, I made sure to tell everyone we are calling for a primary degree bear market rally. That's a substantial degree. It means that social mood is going to have a pretty dramatic swing during this rally. The latest reading was 89%. If we get any more up days, it could even get to 90. These are pretty rare numbers for the S&P. There were stretches in 2006 when it hung in the 90s the whole way, but that was one of the greatest tops of all time. And this is just a bear market rally, and we are already in the forecasted price zone that we think should stop the rally, and now, naturally, we're seeing everybody turning really bullish.
With regards to bringing this around for the investors and the traders that listen in, and I think this is your message to some degree from Socionomics with regards to the financial side, you're trying to basically teach people that aren't patterned to do this to have an understanding of being a contrarian and looking at these types of things you and I are discussing, correct?
Well, that's a big portion of it, but Socionomics is such a rich field that a few months ago, in March of this year, we started a brand new publication called the Socionomics. And I've got a terrific team of guys that have been writing just really groundbreaking studies and work, and they're fun to read, about how waves of social mood are actually regulating all kinds of things, from when epidemic disease is likely to break out, to when militarism starts on the rise in Russia, to what's likely to happen with prohibition. You know, we've got this drug war going on, and we've predicted the end of that in the next decade or so. Because it's a classic thing that happens in the declining trend. So it's been quite a fun ride. We've only begun it. There's so much more to talk about. I think we could write these kinds of things for years. I'd also like to try to get another couple of academic papers published. It's difficult to do, but I think ultimately it's worth it.
Since you're starting to bring in these other items, you have a society that really hasn't had to struggle before. I mean, really struggle in the United States since the Great Depression, right? So now they're struggling, some of them, to pay rent or even to buy food. And interviewing Gerald Celente, he talked about riots in the future. What will the future look like in this country as we go through what you describe as an even worse depression, Bob? And please provide as much basic detail as you can.
Well, first of all, I think is the financial side of things. You're going to see a lot of bank failures despite the FDIC, actually because of the FDIC, which is a whole other discussion. I think you're going to see insurance companies not being able to support all of their promises. I think pension funds are going to implode and be worth a whole lot less than they're worth on paper today. But then you get the problem of businesses closing because that leads to more unemployment. I also think the unemployment benefits are going to run out from the states. So it should be a larger percentage of unemployed than we had in the bottom in 1933 of the Great Depression. Okay, so what does that mean? Back in the 20s and 30s, the majority of Americans were employed on farms. And today, very few people are employed on farms. And back then, if you were on a farm, at least you had a place to grow food, and live. You probably grew up in such a way that you were out pitching hay or something like that as a child. And people today are quite different because back then we were peaking a fifth wave of what we call a third supercycle wave, and this time it's the fifth wave of a grand supercycle wave, which is very, very large. So the setback is going to be larger, and people are going to be less prepared to deal with it. And that's one reason I published this book, Conquer the Crash, because I wanted to try to get as many people as possible into not only very, very safe investments in the safest possible institutions, but also thinking about the society they live in, physical location where they are, and the jurisdiction where they are, because things are going to get tough and they need to be prepared in advance.
Jim Rogers talked about how during the last depression, children were raised with manners, right? And that we're really not seeing that today by and large in this country. So when you talk about people making sure they're located in a good area or a safe area, can you just elaborate on the importance of that? Because won't we see more riots beginning to happen? Not just people going and acting out at these conferences that the government's holding, but aren't we going to see much worse than that?
Yeah, definitely. We've already seen it in France, for example. They had 1 million people demonstrating all over the country. America has been rather tame up until recent months, and you started to see the anger explode at these town meetings. And as some academic recently argued, most of them